Okay, now we're going to talk about the different types of loans. I mentioned to you before that this is going to get dry. This is where it gets really dry, but it's important so you know the different types of options. Just as a cursory understanding, your lender, your loan officer will be able to tell you what products they offer, what those guidelines are, because every company has different guidelines and every underwriter interprets those guidelines differently. So we're going to go through conventional, jumbo, FHA, VA, USDA, and private money. The first one is conventional, and that is your standard home loan. Typically what you're thinking of is like a 20% down. You have to have pretty decent credit. You can use it for your primary residence. You can use it for a vacation home. You can even use it as an investment. It depends a lot on your credit, depends on your income. If it's a second home, you have to be able to show that you can afford 2 mortgages. If it's an investment, you need to figure out if there's rent coming in and how much that rent's going to be, because that will go to work with that. And you can actually get it down to 3% if it makes sense for you. If you're buying $1 million house and you're putting 3% down, you're going to have a $997,000 something loan, and it's going to be very expensive. It's not going to be that $2,500. It'll be closer to 32-ish. So the cons are you need to have pretty decent credit, but for most of these loans, you have to have pretty decent credit. So 620 is about the minimum. There's some loan products out there where you pay a little bit more for the loan, and you can get down to like 580 credit score, but you're paying for it. And sometimes the bank requires more down payment because it's a bigger risk. The debt to income ratio is always important in a lot of these, except for the VA. They just need to show that you have income. You can waive that up to, anyway, so we can go into that. And if it's less than 20% down, you have to pay PMI, which is mortgage insurance. And that mortgage insurance is there just so that in case something tragic happens, like you lose your job or you can't work anymore, the insurance will take over. And it's expensive, and sometimes you can write it off, sometimes you can't write it off, which we'll go into as well. Jumbo loan is anything over $765,000, and that's a high county, right? And most of the counties around the Bay Area are high counties. They're high cost counties. For 2020, the average is 510. That's for Wisconsin, St. Louis, different areas like that. Anything over that, a jumbo will cover. Now, a jumbo is going to cost you a little bit more. But you can buy into a more expensive area. Like if you're buying in Almaden, Los Gatos, Saratoga, those houses typically start around $1.8 to $2 million and go up from there. We have houses that are $34, $50 million, but those people typically don't need loans. And with a jumbo, you can get down to 10%, which is good, but then the offset to you is that you're paying more monthly. And you need a pretty good high credit score, 700. Typically what they want to see is 720 as excellent, but they'll bend down to 700. Sometimes they'll waive it and go down to 680, depending on circumstances and certain companies. The last bullet there, you need to have significant reserves. So they're asking for 10%. So in your head, you have to know that you have to have like 80,000 liquid or semi-liquid. What they're going to ask for are your retirement, stocks you own, your savings, your checkings, that kind of stuff. That goes back to the paperwork part. All right, FHA is a great loan. It's kind of difficult for us in a very competitive market because there's certain requirements that an FHA typically requires. Great thing is you don't have to have great credit score. You only have to have 3.5% down. You also have to have closing costs, but sometimes you can ask the seller for closing costs. That gets a little tricky because if you do that, then the seller is going to go with another loan or another offer because you're not as competitive as that other offer. You are allowed a higher debt to income. Sometimes that can get waived up to 55 and 60%, but that's something you have to decide with on your own. And the cons are your total cost is higher because it's a bigger risk to the bank, and you might not see 2.5% or 2.75. That's what we're seeing right now. You probably see something between like a 3.25, 3.5, because it's a bigger risk to the bank or to the lender. Those restrictive housing standards, again, I mentioned it earlier. What that is that they're going to do a habitability appraisal. They're going to look in and make sure that there's no leaks, that there's no mold, that the water works. And also they're going to require you to do a pest report or clear section 1 of the pest report. We'll go into that a little bit better, more detail in the inspection part, but there's 2 different parts of the inspection, the pest inspection. And one is live evidence of any infestation, mold, mildew, skunks, raccoons, termites, bugs, that kind of thing. We need to make sure that that's cleared out. And if there's any damage, that has to be fixed. And if you see those tents, that's typically what happens. We tend to kill everything inside and start over again and do all the repairs. And the other thing is because it's 3.5%, you have to have mortgage insurance. It's primary mortgage insurance is what PMI stands for. And the only way to get rid of it is you have to refinance that loan or sell the house. And this is a side-by-side comparison of the 2 most common loans that we see, conventional versus FHA. So you can take a couple minutes to look through that. If you have any questions, talk to your lender, or you can give me a call. Now we're talking about VA and USDA. Veteran loans are one of my favorite ones because it helps our veterans get into homes so they don't have to rent. And the great thing about that is it's 0% down. There are certain qualifications you have to have as a veteran to be able to qualify for it. I have other videos that you can watch. I have hour-long videos that go through the entire process of the veterans loan. And there's a couple different types of loans. There's a CalVet and a VA loan. And the VA loan is favorable. It's more aggressive on price. It's more aggressive on interest rate. When I say price, I mean interest rate. And you don't need a down payment. You can have a down payment. It's always helpful because if you're buying $1 million house, you're paying $1 million loan. If you go down 20%, you have less of a mortgage, less monthly payment. So it's better to do that. But if you don't have it, that's great too. You can also ask the seller to pay for closing costs. You can have them do some repairs. The veteran isn't actually allowed to do any repairs on the house pre-closing. So there's really no money out of pocket for a veteran. USDA is kind of like the same thing, except for they require certain higher guidelines. You can do 0% down. The loan is going to be a little bit more expensive. The interest rate is going to be more expensive, but not every house qualifies for it. It has to be more in a rural area. It could be, I think there's like a minimum of 1 acre, maybe 5 acres, depending on the county, depending on the lender. And the great thing about the VA loan is you can use it over and over and over again. So I'm actually coaching a couple Marine veterans to buy triplexes and fourplexes and live in it for a year or 2. 0% down. They have everybody pay, all the renters pay towards the mortgage. And their mortgage, their total left over is like $600. And after a year, they go and refinance that house, that triplex or fourplex, and buy another triplex, fourplex, live in that one for a year or 2. And then they start building equity that way. And that's a great investment product for long term. So there's a lot of things you can do. So, but that's the VA loan. USDA loan is a little more tricky. It's more for rural areas. It can't be income producing, that kind of stuff. All right, private money or hard money. I'm sure you've seen this before. And this is not generally speaking for buyers, home buyers, people that are going to live in the house, because sometimes the loan to value has to be really steep. You have to come in with like 30% down. And sometimes they require 3, 5, 7, 10% in points on the loan, which is crazy. But if you're a flipper or an investor, it's a great option for you because you can buy it really quick and refinance within 6 months, a year, And then you're often running with a conventional loan again, or a jumbo loan, or what have you, right? If you're a first-time home buyer, it's going to be a little more difficult because one, you're not going to have 30% down plus those points, and it's really expensive. And it's typically you're not going to see really competitive interest rates either. You're seeing, like 5, 6, 7%. All right, so now you kind of understand the different types of general loan products. There's a bunch of other ones out there, and every loan officer is going to have special little scenarios and different types of bank or loan products that they can offer. But generally speaking, that's what you're looking at. You're looking at those five different types of loans, and you understand the pros and cons to it. Again, if you have questions, talk to your loan officer and they'll walk you through the pros and cons from their standpoint.